The majority of the people I've talked to about crypto see the market purely as a casino. Bet on red, black, or zero. The market has poor stats. 97% leave in the red. That's why the market has such shitty statistics that about 97% of people leave here with minuses, and most of them, of course, completely lose their money. Many mistakenly believe that it's all about some technical analysis, having insider information, or some other nonsense. Maybe they think it's just about finding some personal strategy or something like that, I don't know, like a Mason reptilian who will reveal all the secrets of the market to them. Maybe they think it's just about finding some personal strategy or something like that, I don't know. A Mason reptilian who will reveal all the secrets of the market, but that's not actually the case. The main problem people have in the market is the lack of basic understanding, market and human psychology insights. And today I want to share with you 10 of my findings on this topic. Understanding market psychology, understanding your personal psychology. And I think this will probably be the most useful video you can watch if you're planning to get involved in crypto trading or, yeah, even in stocks, because you can mess up there too. People get taken in about 95% of the time, except for some really stubborn individuals. It's mainly because they don't understand what will be described in this video. People are being sold in probably 95% of cases, but with the exception of some very stubborn individuals, it's precisely because they don't understand what will be described in this video. Understand the market's purpose. It transfers money from the poor and impatient to the rich and patient. It's a mechanism designed to take money from the poor, the greedy, the impatient, and redistribute it to the rich, the patient, the powerful, and so on. And that's really how it works. To the patient, the powerful, tillions, the oils, and so on. And that's really how it works. I'm not joking right now. The market, no joke, helps to redistribute financial flows from the poor to the rich. The market isn't exactly a friendly, sunny place like you remember from that famous movie. The market is really dangerous. It's a tough place. That's the moment many people don't get. You come to the market and compete with other people. I mean, you understand that the market, well, a big part of market interaction is a zero-sum game. You come to the market and compete with other people, so you understand that the market, well, a big part of market interaction is a zero-sum game. In simple terms, if someone made money, it means someone else lost it. If you bought low and sold high, it means someone bought it from you at a high price. And most likely he won't be able to sell it at the same price later. Well, if you did everything right, when you start to understand this and begin to think about who you're actually playing these games with, well, I mean, who are you competing against? Who are you playing against? It turns out that you're playing against the smartest people on this planet. Against the smartest analysts, IT specialists, mathematicians, and so on. And you come in and try out different tools to beat these very smart, very influential, very powerful people. So the next time you want to enter a futures trade, you might want to leverage it a bit more. Just remember who you're betting against and who you're dealing with. The next thing you need to understand about the market is that it will constantly make you experience various emotions. It can be greed, fear, it can be a fear of missing out if anyone doesn't know what that is. Missed opportunities. It's probably the foundation of most scams, fraudulent schemes out there. And everything that is connected with this is those situations. When you find yourself, it seems to you, if I bought Bitcoin for $1,000, I'd be a millionaire. The market can cause disappointment. Or if I had invested in that pyramid scheme earlier, I would have already made my, I don't know, sweet couple of $1 million and so on. Naturally, the market will make you feel disappointment and despair. When everything is going to drop, when what you bought drops by 80, 90%, you'll want to sell it and so on. The most interesting emotion that people rarely think about is called tilt. It manifests in different ways. For some, it's a dizzying feeling from success. For others, it turns into typical gambling addiction when I put, I don't know, some amount of money into the market, and you think, right now I'm going to make a comeback. Or on the contrary, you might have a streak of good luck. For example, you took 10 consecutive profitable trades, everything was calculated perfectly, you guessed right, and you think, well, why should I follow risk management? Why should I listen to any advice, the right advice? I'll just go all in, leverage it up, and put in a bigger stake. And at that moment, the market makes it clear who you really are. I already mentioned in one of the videos that futures trading and the markets, even if you don't plan to closely tie your life to the financial sphere, I believe this is an experience that everyone should try. It will give you an understanding of who you really are in this life. You'll understand much better how your psyche works and how your emotions function. Well, now let's move on to the rules. I recommend that you seriously take these rules and write them down on a piece of paper. The first rule, buy, sell, green. This moment seems obvious. Everyone knows to buy low and sell high. Yet, in the market, people often do the opposite. When the market rises, it's tempting to buy, thinking Bitcoin at 60K in 2021 will reach 100K or more. But when Bitcoin drops like to 600K in 2022, it seems less attractive. It seems to us that when Bitcoin is worth $60,000 there, in 2021 it will grow further to 100,000 to 120 and so on. And when Bitcoin drops, for example, by $600,000, yes, like in 2022, then it is no longer such an attractive asset. Because FTX went under because of crypto scams. Because some people got arrested, some things got blocked and so on. And if you follow at least this simple principle, that is, if you see a big red stick globally, then you have some asset that interests you. Well, for example, the same Bitcoin, just buy it. And do you have some asset that interests you? Well, for example, the same Bitcoin, just buy it. I don't know, you shouldn't mortgage your kidney, house, wife, or apartment. No, you take a small part of your deposit, that's 5%, and you just buy regardless of whether you see a 20 or 30% candle and so on. If you see another candle forming, you get a better button like a bonus gift. That's why we don't use our entire deposit, but rather just 10%, even if it drops another 30%. We keep buying more with the same 5-10%, and so we reach the values that were initially outlined in our strategy. I want to convey the main idea. The thing is, when you break these rules, specifically this rule, you will lose your money 95% of the time. So when you're selling at the highs, you'll be riding the waves and selling at the lows. So don't make these mistakes. Don't buy green. And most importantly, don't sell the red. But if this, again, doesn't align with your strategy. The second rule, don't react to the superficial background, and remember rule number 1. As a rule, the market is structured like this. If something is dropping in price significantly, it is accompanied by an extremely negative superficial background. For example, when crypto is dropping, either some exchange is scamming, or some banks are getting blocked, or stablecoins are being scammed, or something else happens. You know, something like that. Your task in this situation is to not react to what's happening in any way, because this news is exactly what is being made to make you sell those assets, or to make those who are holding those assets sell, and to prevent you from buying. Your task, when you're looking at the news background, is to think, did this news even come out? For what purpose? To really highlight some objective reality maybe in the world. Indeed, something like 2008, where we have a global financial crisis, a recession, and honestly, right now is not the best time to buy. With experience, you'll learn to do this. The most important thing, yes, in this situation is to not pay too much attention to the news and not to give it too much significance. Most news inflates the hype. By exploring PR and marketing, you'll see how it works. Understanding media operations reveals it's a sales-driven industry. Billionaires aim to influence Bitcoin or other assets through media using the right information environment. If they need to highlight negative or positive news, they'll ensure it gets attention. Their goal is to move Bitcoin or other assets in the right direction through media. And if there's a need to highlight negative news more, they'll definitely do that. If they need to highlight positive news, they'll definitely do that too. That's why we need to rely on common sense and not believe everything. What they are trying to convey to us in the media. The next rule is stated as buy when you want to. You need to sell when you want to buy, and you need to buy when you want to sell. It partially overlaps with the first rule that we discussed. Buy red, sell green. This is basically about how human psychology works. We've already mentioned that the main task of the market is to make you make irrational decisions, so that you sell low, buy high, and by no means the other way around. And if you feel that you found the deal of the century, right now you're going to buy this altcoin or this stock or, I don't know, this apartment, and it's going to completely change your life, then there's a 90% chance that you shouldn't make this deal. If you feel like you're absolutely sure that the market is going to rise and Bitcoin will reach $1 million, everything is going to be just great. Crypto is flying to the moon. It's probably time to sell all your positions and exit the market. So don't try to take all the money from this market and try to act just counterintuitively. Next, the fourth rule. You should have a strategy written down on paper. You need to research critical situations and avoid making emotional decisions. We will talk about emotional decisions separately, but I want to tell you that the quality of my trading, the quality of my deals has improved significantly after I started writing them down on paper, after I started clearly outlining them, after I started writing them down on paper, after I started to write it down clearly. For example, I'm sitting here and I have some asset like Ethereum or Bitcoin and I'm planning to buy it and then hold it until certain levels. And then hold it until certain levels. I'm putting the chart. It's best to do this when you're calm, when the market is neither going up nor down, when it's just in some kind of flat. I determine the levels at which I will buy Ethereum. You can even jump in right away, set some limit orders or something like that. Yeah, so you don't have to think about it later. There in the moment to jump in and buy with shaky hands. So I go in and write down on a piece of paper that I'm going to buy Ethereum. Around these values, 1, 2, 3, 4, 5. So when Ethereum reaches these values, what am I doing I don't pay attention to the news background. I don't even open the charts there specifically because I looked at the charts beforehand. Well, why should I open them? I just jump in and buy more. This strategy obviously only works for medium or long-term trading. It's clear that this doesn't work for short-term speculation. The principles are different. We can take that out. Probably the fifth and unusual rule is that the easiest way to make money in the market is by using medium and long-term strategies. At least for me, with my personality type, scalping is really hard, and short-term trades are very challenging. When you have plus $10,000 today, minus $10,000 tomorrow, you kind of get a bit emotional. And as a rule, for most people, it's much easier to earn that money in other places with less emotional strain and less impact on physical health. Because all of this is unlikely to give anyone strength and emotions, it rather takes more away. Medium to long-term trades are for a person who doesn't plan to become a professional trader. I believe they should form the foundation of his strategy, so everything we talk about will be taken into account more for medium and long-term return to the fourth rules again, and the previously described strategy. It helps you avoid stupid mistakes. Understand that when you're in the market and you see big red bars, you won't want to buy. But when you see big green bars, you'll want to buy. Your task is to write down on a piece of paper what you will do in each situation and not make foolish decisions. It's all really quite simple. But unfortunately, only those who have probably already made some stupid decisions and have gone through various experiences in the market will truly understand this right now. Your task is to write down on a piece of paper what you will do in each situation and not make foolish decisions. Everything is actually very simple. But unfortunately, only those people who have probably already made some stupid decisions and have gone through various experiences in the market will truly understand this right now. When you start describing all of this, you'll notice how the quality of your trades, the quality of your trading, will improve significantly. It will improve significantly. The fifth rule, create conditions for yourself where the market won't pressure you. What does this mean? You could go on for a long time giving lectures about risk management, about how to manage your deposit and so on, but I'll explain it this way. When you make trades in the market, your task is to ensure that these trades don't pressure you, neither psychologically nor financially nor in any other way, because, well, imagine you go on a date with a girl and the girl is nice, beautiful, you like her, everything is just wonderful. But you understand that this is the last woman in your life and you have no more chances left? Just none. As we understand, relationships between people can develop in different ways. You might not appeal to the girl, you might not match in terms of personalities, or you might just not like each other for some trivial reason, like a certain smell. And what will you do in this situation? Are you going to bang your head against the wall? You just need to approach this situation a bit more simply. We understand that the girl isn't the last one in this world. Will there be other girls to meet? Better ones, less good ones, more beautiful ones, less beautiful ones, ones that suit us better and ones that suit us less. And we should feel the same way when we act in the market. So we need to be aware that the calmer we are mentally, greater our chances of taking money from the market. And so when we step into the money, well, let's consider that you have, I don't know, $100,000, let's say, as a deposit, just to make the calculations easier. $100,000 is actually all your capital. That's all the money you have. In this situation, I wouldn't invest more than $20,000, $30,000. I probably wouldn't allocate anything to crypto at all. So I would spend the rest of the money on real estate, on some stable securities in the stock market. So this is something that might not give you huge returns, but it also won't lead to a significant drop. When you enter the crypto space, you should inherently understand that you are dealing with a highly risky asset. And if you think you can make a lot of money in crypto with your $100,000, and if you put all of it in now to try to get 10x, you're likely to lose your money here. It's precisely because you will feel extremely uncomfortable regarding the market, use comfortable amounts of money. It will be easy for you to interact with the market, and it will be very difficult for the market to affect you. This is a rather subtle point, which you will probably come to a little later if you don't listen to me now. But better early than late, just more money for yourself. Save it. Here, of course, I need to say that you should never enter with any borrowed money or anything like that. It's just a direct path to ending up with debts. I just know I've heard a lot of different stories, including those related to crime. Well, basically all sorts of bad stuff. You really don't need it, believe me. So, no borrowed money. No loans, trade only with your own money. If you don't have money, then you need to go to work and create more value for this world. So do you finally have more money? Yes, by the way, about the situations where the market won't pressure you, a little life hack for those who trade on the spot and buy altcoins. I always withdraw my positions from the exchange so I don't make stupid emotional decisions. Because when you have coins sitting on the exchange and they, for example, have dropped significantly and you really want to sell them, you logged in, pressed one button, I sold, locked in the loss. Everything's messed up. The next day they grew by 50%. This happens very, very often in crypto. When they're sitting in your wallet, it's just a lot harder to do that. So you have to transfer them somewhere, deposit, withdraw, every time. If you think about what to do with some altcoins, it's better to keep them at a distance, so you don't make foolish decisions, especially if it's your last bit of money and so on. Especially if it's your last bit of money, and so on. The next point, you shouldn't be completely in the market or completely out of it, except in some extreme situations. What is implied here? This is my strategy. I feel uncomfortable with full positions. I prefer gradual market entry and exit. Being completely in a position or completely out of a position, I prefer to gradually to the market and gradually exit the market. Again, for example, let's say we have $100,000. We are in the year 2021. When Bitcoin is priced at something like $60,000, we're expecting a bear market. Everything like that, it keeps falling. Let's say we start buying it with $30,000. How do we start buying it? So I always start buying a little bit at a time. For example, I bought at 30 for 10%, at 25 for another 10%, at $20,000. I bought another 20%, 16%, I bought another 20%. What's the point? The point is that I'm constantly in the market, depending on the current market situation. The lower the asset I'm interested in falls, the more money I'm obviously willing to put into it. But at the same time, I don't get carried away with this, and I don't try to take all the money from the market, because as we've already discussed, and the good thing is it never ends. If what I'm explaining resonates with you, these medium-term and long-term trades, then it's probably for you. Being completely in the market is almost never the right strategy. Just because, going back to the previous point, what was it again? 5th, 6th, I don't remember anymore. When you're fully in the market, you feel pretty weak in relation to the market itself. And you find yourself in a vulnerable position, which I believe should absolutely not be allowed if you want to make money. So the second point here, for me, it's almost never comfortable to completely exit the market. Why? Just because assets can keep growing indefinitely, especially when we're talking about crypto, especially when we're talking about it when it comes to some altcoins. Most rational strategy here is obviously the previous point, where we set exit levels in advance. But the last exit levels are always extremely optimistic. And of course, we take the chips off the table, we take profits from the position, that's not even up for discussion. But we need to understand that when we are out of a position and the market will grow, we're going to experience some serious FOMO. So imagine you see something growing and you don't have a single penny in that asset at all. You're sitting there, I don't know about you. For me, I'm just incredibly anxious. And when, well, okay, I've already unloaded part of it, I still have some money left, but I know that this thing is growing and I'm making a little bit of money along with it. It's much easier to deal with this now. Here, of course, one could say that, yes, you can't earn all the money in the market and so on. But here, again, I'm looking purely from a psychological perspective. So I understand that if I frequently and intensely experience FOMO, then most likely at some point, my psyche will give in and I won't be able to come to terms with myself. Many people overlook one simple fact, that they are an emotional being, and usually an emotionally unstable being, which is called a human. And it's strange, but humans tend to make some of the most irrational decisions in life. And further you can protect yourself from these irrational decisions, the better. This applies not only to investments, trading, and so on. This applies to life in general. But in investments and trading, this is expressed as a super core issue. And when I think through my strategies, action plans, I always take the emotional aspect into account as well. So I'm looking to make sure I'm comfortable from a psychological standpoint, so that FOMO doesn't torment me on one hand, and on the other hand, I'm not sitting in a wild drawdown without the ability to average down and buy the assets I'm interested in. Again, this may not be the most profitable strategy at the moment, but in the long run, I think these rules give very good profit and make you. You can be a much calmer, much happier person without overthinking things too much. You don't need to get involved in all sorts of confusing stuff and stress out because you didn't buy something or didn't sell something. Again, if you've set yourself some pretty optimistic goals and your position still worked out, you don't need to get involved in all sorts of confusing things and freak outs because you didn't buy something or didn't sell something. Again, if you've set yourself some pretty optimistic goals and your position still worked out, well, I don't know, maybe you can sit with a bit of FOMO, but everything has its reasonable limits as a rule, the 7th rule. Don't make promises quickly. This is probably the main problem people have in the market. What expectations are open in general? Right now it's raining, and I'm thinking about some incredible, just crazy returns, and suddenly I'll become a millionaire. Basically, If you choose your assets appropriately according to your strategy and your trades are more medium to long term. It's extremely rare that you'll buy something and it goes up the next day. You might get lucky once, twice, 3 times, but in most situations that won't happen. I would even say that if you initially got lucky and bought something and it grew tenfold in 3 days, most likely this will mess with your mind. It will unteach you and you'll expect those movements. Always. Maybe on a meme coin or futures. So again, when opening a position, approach timing realistically. In some random meme coin or in futures, open positions with realistic timing. Include holding duration, your strategy. Planning ahead simplifies this. And going back to the question of strategy, of course, it's best to describe in your strategy how long you plan to hold your position. If you think about all of this in advance, it will be much easier for you. That's all to do. The next point, always have a description and always have a justification for your trade. Moreover, it's preferable that this justification is written down. Every time you open a position, when you buy some altcoin or when you buy Bitcoin, you should always take a moment to write it down. You can take a pen, you can take a laptop, but you need to clearly write down why you're opening this or that position. What are the valid reasons for opening this trade? It's important not just to think these thoughts in your head, but to actually write them down. Because when you start writing them down, you'll realize that most of your trades are ridiculous and unfounded. This point is exactly what significantly improved the quality of my trading back in the day. It improved the quality of my trades. I started making a lot fewer random, thoughtless, emotional decisions. There are actually 2 simple rules. Describe your strategy. Yes, we've already discussed that. And provide a written justification for your trades. This is something that 95% of market participants don't do. Just seriously.
Talk to people. Ask who writes down their trades in text, who writes down the justification for their trades.
I guarantee you, no one. No one. And this is actually one of the reasons why most people lose their money in the market. And it's the same here. When you get a recommendation, what's the downside of trading based on signals? What's the downside of following someone else's trades? It doesn't matter if you're following my trades or someone else's. When you don't have a rationale for a trade, it's very difficult to stay in it. When you don't understand what you're doing and why, it's very hard for your mind and your psyche to make balanced and reasonable decisions. But when you take the time to clarify things for yourself, it's very hard to make balanced and reasonable decisions. When did you take it for yourself? You describe the trade, the entry points, the exit points, the justifications. Even if you end up with a loss on it, you'll be able to analyze it and you'll understand where you went wrong. Or maybe there were really factors that were completely out of your control. Be prepared from the start that you will sooner or later, most likely sooner, encounter 13 losses in the market. The market is a theory of probability, and in a way, it's like a casino. Well, depending on the phase of the market, you'll encounter 13 losses in the market. The market is a theory of probability, and in fact, to some extent, a casino, so no one knows for sure where the market is going. Some reptilian knows, but the reptilian won't share the secret of where the market goes. Tomorrow, the market is a casino. The reptilian Mason, unfortunately, won't share with us the secret knowledge of where he's planning to send the market. For example, tomorrow, the market is a casino, and you should treat it accordingly. You should not go all in on 0. Assess chances realistically. Not every trade profits. Losses are likely eventually. Profits are possible, but losses will occur. You will make a profit, and it is quite likely that you will have it sooner or later. A series of losing trades will happen to everyone sooner or later. Believe me, that's just how it works. The theory of probability, at least I don't know anyone who makes money in the market without having that kind of experience. The next point, number 9, withdraw money from your trades. Paper profits don't count. This is something I often faced in my time. When you're trading successfully, everything seems fine. There's profit in the trades, but you're being greedy. You don't withdraw money, you don't close out on those trades that you wanted to close, or maybe you close out, withdraw part of the money and leave it in your account, just in dollars, but you don't withdraw them. You don't spend them on buying cars, real estate, or other assets. And here we return to the very first question, to the second one, all right, about the strategy. So what does your strategy involve? What are you going to do with the money you've earned? When will you take your profits? And the problem for most people isn't even that they don't take their profits, but that they don't even know when they plan to take their profits. So they don't have any clear plan for when they're going to do it. At what price points will they sell? What will constitute a good profit for them? And so on. The question of describing a strategy and the approach to your positions, I believe this is actually one of the first things you need to focus on. Save this video for yourself. So if you still don't fully understand what I'm talking about, but if you plan to stay heavily involved in the market, save this video for yourself and watch it again in 6 months, in a year. Because of the newbie, it will be hard to grasp what we're discussing here. For an old-timer who has already gone through a couple of them, well, not the most pleasant situations in the market, maybe a couple 100 unpleasant situations in the market. For such people, what I've described here will be much clearer. Maybe you already felt this on some intuitive level just here. I'm giving you this in a more, well, let's say condensed format and more packed. So you can take it and break it down into points, into theses. By the way, everything I'm telling you, yeah, that's where the idea for this video came from. I have my own notes. I also recommend that you keep notes on different topics. For example, I have notes on the topic of trading. And when I trade, obviously, I make all sorts of mistakes. But the most important thing is not to avoid making mistakes altogether. The most important thing is not to make the same mistakes over and over again. Time and again, the best way to deal with this is the simplest, most basic thing, writing down your mistakes. A note, you just write them down, and then you naturally come back to these notes regularly. And over time, in the process, you start to make fewer stupid moves. And over time, you realize another interesting point. What matters much more in the market to make money, it's not about making some super smart moves, having, I don't know, again, some familiar reptilian who will give you secret super signals. In the market, it's much more important not to make stupid decisions. So if you just don't make stupid decisions, you'll already be much smarter. 90% of the participants in this market, yes, you still won't be smarter than those hedge fund managers. You won't be smarter than those algorithmic programs that hunt for stop losses and all that. But you'll already be smarter than the main retail trader, which I believe is more than enough to make money over a more or less long distance. Well, as I already told you, the longer your approach is, the longer the time horizon for your trades, the greater your chances of making money in the market. I don't have that rule. It's very controversial, very controversial. I don't recommend shorting the market. If you're a beginner, obviously, if you're a professional, you'll figure everything out on your own without me. You already know everything. But if you recently entered the market, don't use short positions. Why? Let me explain. Let's imagine we have some altcoin. It costs 100 rubles for an altcoin, up to $100. It doesn't matter. How much can we make by opening a short position? The maximum we can earn is 99%. So it went from 100 rubles became worth 1 ruble. Moreover, there won't be that many situations like this in the market. But on the other hand, the same altcoin that costs 100 rubles, how much can it grow? Yes, essentially by an infinite number of percent. Conditionally, it can grow by 10 times, by 100 times. Well, let's say by 10 times, cryptocurrency can really grow by 10 times. Calm down. By the way, there have already been such cases this year. One of such cases is VLD, TON. I think TON didn't grow by 10 times. It gave about 5 or 6 times. But the essence is that by opening a short position, you are initially putting yourself in a mathematically disadvantageous position because you can only earn 99% but lose 100. In a long position, you're in the opposite situation. You can only lose 99%, but you can earn conditionally an infinite number of times, percent, and so on. Once again, this doesn't mean that you'll earn 100%. This doesn't mean that by opening a long position and holding it for 10 years, you'll definitely become a dollar millionaire from $100. No, it's just about mathematical expectation. What if you're just taking your first steps in the market? The short button is not what you need. Of course, if you're into short-term trading, speculation, or scalping, then this rule doesn't apply here. But if your main goal is to earn on your positions in the long run and on average, especially if you plan to cash out in the regular market and you've entered the market at a good time, then short button is probably something that shouldn't be part of your trading strategy. So friends, a new experimental format. Share your feedback in the comments. Don't forget to subscribe to the Telegram channel. The link is below this video. I hope this video was extremely helpful for you. See you soon.